Chapter 4 covers income tax withholding. So the first thing it talks about is what is required, like what type of wages are required for federal income tax withholding. So that FIT stands for federal income tax withholding. So what gross amounts are taxable? So obviously wages and salaries that are paid are taxable. Vacation pay is taxable. If you get any year-end bonuses or commissions and tips, all those things are kind of part of your regular paycheck. Maybe supplemental payments, like again, which would be kind of more bonuses or for something specific related to that business. Even if there's cash awards, so like say you win the best employee of the year and you get $1,000 check for cash rewards, that will end up in your W-2. That is taxable income. Taxable fringe benefits, which we'll have on one of the next slides, talk about the details of those. Moving expenses, so if they're going to give you money to move from one state to another state, that is taxable. I think I already mentioned sick pay. Cash allowances. Now that is, sometimes there's people say, like if you're a union, construction person or electrician or something like that, and you travel to locations and then they let you go ahead and find your own hotel and cover your own food, and they give you like a daily allowance that should cover the meals and lodgings. So that if it's not for their benefit, now that example might be for their benefit, but if it's not to their benefit, where it's not directly impacting the employer, then it would be taxable to that worker. If you're disabled and you receive disability pay, that is taxable. And then travel advances, again, that's kind of similar to what I was just saying, where they give you a certain dollar amount, but they don't really hold you accountable to it. So I've worked places where I've traveled for business and they would give you those travel advances, but you would have to then turn them back in with receipts. So to say, okay, this is how much I spent for my hotel, this was what I paid in tolls, this is the gas I had, or whatever those would be. If you did not turn those receipts in, then that would become taxable pay to you. So then the fringe benefits, what's included is in your income is tickets to athletic events. If they pay for you to join an athletic club, or sometimes we had employees at the oil and gas company that I worked for that would have been members of country clubs. And if we paid for those would be taxable to them. Personal use of a corporate car, if they paid for your vacations. So those are things that I think a lot of times, businesses used to be able to do some of those things and not have it be taxable to the employee. But then the IRS has kind of caught on to that. And so now they're making those taxable to them. If they could give them an employee discount, say you work at Kohl's and you get 25% off all your purchases, that's not going to be taxable to you. If they provide an athletic facility, like I worked at that oil and gas company, we did have an athletic or a workout area in our office. And obviously we could use that before or after work or on our lunch breaks, and that was not taxable to us. If they pay for your tuition or something along those lines, or again, meal and lodging for their benefit. So like I had to travel for work, I would have to go down to Texas sometimes for our year-end close, and they paid for all my meals and lodgings. I didn't even handle it. They really just paid for it just right off the corporate credit card. And then if they were to provide you like a cell phone that, again, you're using for business, but obviously you could make personal cell phone calls on that, and that's not taxable to you. Then there's some unique things that church ministers have. Their pay is exempt from withholdings. Again, travel and business expenses that are legitimate and that are going to be accounted for. Educational assistance up to $5,250 a year. Moving expenses for active military people. And then there's a transportation amount up to $265 a month. Probably again in your big cities that might be more of an issue. Then there's things though that as you have a job that has more benefits, there's things that you can pay into that then will be deducted, and those will be deducted pre-tax. So then you're saving the tax dollars. So if you contribute into a cafeteria plan, um, or into like what we have at work, we've had, like, say you're paying in for your childcare and it's coming directly out of your paychecks. That is something that would come out pre-tax. If you That has to go right to the childcare though. It can't go back to you, or if it does, you got to show that you've got a receipt for it. Or we have money that can go into like a health savings account. So again, it's up to a certain dollar amount that they allow, and only a certain dollar amount rolls over to the next year if you don't use them all. But the nice thing about that is all pre-tax dollars that every year I put so much in. I've got 3 kids, and for sure there's going to be healthcare costs that come up. Um, so those are, and then the Archer Medical Savings Account would be about the same way as the health savings account. And then in cafeteria plans, that's where they have a variety of different benefits that you can choose from. You can elect to be part of them or not part of them. So you could have, health insurance, because again, maybe your husband has it and you're going to choose not to get it. Dental or eye coverage could all kind of fall into that category. Group life insurance, sometimes they'll cover a certain dollar amount based on your employment. Sometimes you have to pay extra for it. The child care and the health savings, again, we talked about those on the last slide. Benefits that are not included, again, transportation fringe benefits, which I think we talked about on the slide before, educational assistance if they're paying for you to go back to school, meals and lodging at the employer's convenience. So again, like I said, when I traveled down to Texas to close the books, those were not included. And then any deferred compensation. So like with that oil and gas company I worked at, our executives, our high paid executives, did have a deferred compensation plan. So that part is not included. Now, we also had a regular 401k plan that everybody could participate in, including those high paid executives. Now, that would be anything you contribute into that 401k plan or that retirement plan would come out pre-tax dollars. So that is a big thing. So that's what this next slide talks about, the different types of plans that you have. So most common is 401ks. Most corporations have that, where the employee is going to contribute a certain percentage of their paycheck. A lot of times the employer matches it. So like at the oil and gas company, we actually had a very good plan. They would match up to 6%. So if I put 6% in, they would match 6%, which is pretty huge. You could do more. I mean, you could put like up to 10%, I think, in, and then but they would still just match the 6%. Then you have like pensions, like which are sections, the 403 plans. Those are more pension related, but again, a certain amount's coming out of the employee's paycheck, and a certain amount is being paid by the employer. So those are all going to be withholding. They're going to come out pre-tax dollars. You still pay FICA on those, though those don't save you from a FICA standpoint, just from a federal income tax standpoint. Then maybe smaller businesses who don't have 401ks may set up individual retirement accounts and allow for employees to contribute into those. Maybe they even match them, but those two will come out pre-tax dollars. So then we get into, well, how much do we withhold? So now we kind of know, okay, what wages are taxable, what can we deduct, before calculating the taxable liability. Then we get into, okay, what is the individual's specific allowances? So that individual should fill out a W-4 form when they very first start. And on that W-4 form, which is on the next slide, they'll choose I'm single, I'm married, or I am married but still withhold at that higher single rate. And then you can put in one exemption for yourself, and then additional exemptions for any dependents that you have. Now that's your choice though, because sometimes people who are married still want to say, hey, withhold at the single rate and zero allowances, because then you're going to have more income tax withheld and you'll get a bigger refund. So in a way, it's a little bit like a savings account. Now, what the top line says is the goal is obviously to just try to have it so you don't get a refund and you don't owe anything. But I do think there's a certain percentage of our population that likes that refund. So if you are one of those people, then you should probably go single and zero so they're withholding the most that they can. Then there are people who can be exempt. So that's a section on the W-4 also. If they had no income tax liability last year and they do not expect to have any this year, they can check exempt and that will last for 1 year. They'd have to file the W-4 the next year because obviously it goes back to your last year's income tax liability. You can't file exempt like if you're say like a teenage person or a college student who's also being claimed on their parents' tax returns, and you have more than $1,100 of income, you cannot claim exempt, so they will withhold taxes. And then the employer should retain that W-4 as long as that employee works for you, even 4 years thereafter. And then here's an example so you can see the individual fills out their name. They check if they're single, married, or if they would like to have it withheld at that higher single rate. Then they put in their number of allowances. And then they would claim here, they would write the word exempt if they felt like they did not have any liabilities last year and they don't expect to have any this year. Okay, then there's 3 different methods. There's the wage bracket method, which is the easiest, and then there's the percentage method. So I give you some examples of those in the notes. So look back over those computations because those are easiest to actually just look at the mathematical computations of those. But it goes to kind of tables to say, okay, well, if I'm or again, the brackets would be like within certain income levels, and I'm single and I have 0 exemptions and I make this much money to that much money, what should be my federal income tax withholding? And then here again talks about some of the different wages. So vacation, because where this kind of comes into play is if say you're getting a big year-end bonus, does that just go on to your regular paycheck, which would put you in a higher tax bracket and the income taxes would be withheld at a higher rate? Or is the employer going to do something different? Every place I've worked has always just treated it like as if it's regular wages, so that you're just, it goes into those same brackets and you do end up with a little higher withholding. But the employer could choose to go down to what is down here on the bottom to say it's just going to be a 22% flat withholding rate. But honestly, that could actually be a higher rate for people as well. So, so sometimes you just have to know if you're going to get that year-end bonus check, the taxes on that can be withheld at a different amount depending on how the employer chooses to do that. And then at the end of the year, the employer is going to required to give all employees a W-2 form, and then they will then submit a W-3, which is a transmittal of all of their wages. So each employee gets the W-2 individually, and then the employer prepares that W-3 to say, okay, this is all of the income that we've had. And it will tie out to the employer's quarterly forms that they are filing each quarter on their wages. So that's a Form 941. Now, if you have more than 250 W-2s or 250 employees, then you have to file those electronically. And then you also can correct it if there's any issues. You can correct W-2s. But there's an example of a W-2 statement. And then this talks more about the quarterly returns, which we mentioned when we're saying the W-3 that the employer files at the year end with those W-2s, that total of wages paid has to tie out to all 4 quarterly 941 forms that they filled out. So the end of each quarter, they fill out this 941 that says this is how much wages, this is how much Social Security income, this is how much tips, it kind of breaks it out in detail. and then how much was withheld. Then it ties it out to, did the employer remit those taxes timely? If it was, if it was a monthly payment, on the back of that form, you would say, this is how much I paid monthly. If you paid bi-weekly or weekly, or at a, a smaller level, there's a separate 941B that you fill out that says, this is the date that I paid wages, and this was the liability of the taxes that were withheld. There can be unique scenarios where the employer is going to report compensation paid to non-employees. So, like if you're a casino or a bingo hall or whatever, that there's some sort of winnings that people can have, though they have to withhold taxes out of those winnings. So that would be an example. Or there's some other unique ones. Like they say, if you have a subcontractor, an independent contractor who is working for you as not as an employee, but as an independent person, they need to provide their tax ID number to you. If they do not, then you're required to withhold taxes and remit them. But that would be done through this Form 945 if you had to do that, versus the 941, which just deals with employees. And then, so speaking of those independent contractors, they get a year-end report, but it is not a W-2. They get a 1099 miscellaneous form, and then the employer fills out a 1096, which would be, so the 1099 miscellaneous would be similar to the W-2, and then it goes to the individual people. The 1096 would be similar to the W-3 in that it's a summary of all of the 1099s that the employer must file with the federal government so that they know who's received so much money. And there's an example of the 1099 miscellaneous. And then there's all these different fields that you would fill in. So normally, if it's like an independent contractor, they're going to have an amount in this non-employee compensation, number 7. This one shows its royalties. So there's other categories. Then our last topic is withholding state and local income taxes. So not all states have income tax. Ohio, we obviously do. And then there's a certain percentage that would be withheld, if you're working in the state of Ohio, if your employer is in that state and you're working in that state. There's also can be local income taxes if you live within a local city environment versus, again, like a township. And that would be, you'd have to work in that environment, not if you live there. If you live there, you still have to pay it. But if you don't work in it, your employer is not withholding those taxes. It's only for employers that actually operate within those localities, and then they'll withhold those taxes. And then there's different, again, depending on the state and depending on the locality, there are different forms that need to be filled out to deal with those income tax liabilities that are owed.